Hi, fellow traders. I hope everybody is enjoying their holiday weekend. I wanted to give you another sneak peek into day trading the average Joe way, which is my day trading course that really teaches everything that I do and everything that I did to get me to where I am today. And I'm very proud of it. I'm glad that I was able to put it all together and be able to share it this way. Now, it's a 100% live interactive class, and they're 15 90-minute classes. Now, we started one rotation about a month ago. We're through the first month, and everybody's enjoying it. Everybody's learning a lot, and they're well on their way to becoming independent day traders. So the 15 90-minute classes, we honestly we haven't cut it to 90 minutes yet. It's always been at least 2 hours that we're there because once we get into something, it's kind of hard to stop. But we try to limit it to 90 minutes as best we can. Uh, Limit the amount of traders that we have in there because I want to give you as personalized attention as I can. That's what I feel makes the difference. Being a teacher, I never really used videos to teach anything. I always demonstrate it firsthand. And that's what I like to do here. Yeah, I will have some recorded classes available because I've got an overwhelming response of just wanting segments. So I'll be doing that, but I will never sell a complete day trading class as a video because it's not conducive to learning. This is not something you can watch a video and then learn. You need personalized attention. You need to be able to talk to someone, to interact with someone. So anytime you have a problem in between classes or doing the homework or whatever, you could always reach out to me on email or we can Skype for a little bit to try to get you back on the right track. And having that ability and having that option, I think is what really makes this class special. And above all, everything that I teach is what I do in chat every day. You get a yearly chat subscription. So you get to see me put everything that I'm teaching into practice live every day. I'm not calling out a trade, say I'm doing this and I'm doing that, and then show you after the fact. You see me doing it, you hear my thoughts as I do it, and I think this is all part of the educational process. And as part of the chat subscription, you get a weekly webinar, weekly education webinar. So you're getting an additional class in the middle of the week. And then on Sundays, you're getting two classes because we do have um, twice a month small group mentoring sessions that's focused on specific issues that our members are having. You will get access to a market replay platform so that you can practice the strategies that I teach, on the weekends, at night, whenever you have free time. And above all, you get a lifetime access to the classes. So not only do you get the recordings of the live classes that you participate in, you have the ability to come in at any time and join in any class while it's going on. If you want, let's say you're having trouble with technical analysis and you can join in the next group coming through, you can join them and take the technical analysis part of the class. It's set up that way. So you have access for life. It will not go away. It will not expire. The only thing that will expire is your yearly chat room subscription. And that starts the day you purchase the class. And you have a year from that date. But even if your chat room subscription, um, even if that subscription ends, you still have access to the classes. That's something that you paid for, and that's something that you will get continuously. Now, the price is $9.99, which I feel is an incredible bargain for everything that you get. You know, my number one priority is to make sure that you learn and that you take in all of the concepts that we're teaching, and that I'm demonstrating them to you every day in chat live. That's my goal, and I take feedback from everybody, and I do everything that I can to get better. So if you want to come join us, our new class is starting April 18th, which is this Thursday. And I think you'll find this class different than if you've taken other classes in the past, I'm sure you're going to find this very different. It's just like those that have been in other chat rooms. When they come in, they find that our chat room is completely different. It's a whole new experience. So give us a try and just stay tuned, and you'll get to see a couple of excerpts from our day trading class. So, this particular trading range is going to be important. More often than not, it's going to set the tone. What we're doing as traders, we're trying to get a feel for the market. We're trying to get a feel for what's the market going to do that day. Is it going to be choppy? Is it going to be range bound? Is it going to push up, or is it going to fade, throughout the trading day? So the opening range kind of gives us an idea of how things are going to be. Now, yeah, you need to use a longer opening range, maybe 30 minutes or so, to kind of get that feel, but it really tells you what the day is going to be like. So between the closing of the previous day and the opening of the current day, different things can happen because there are markets overnight that are open, and those events, they can have an impact on what's going to happen today. We can have government reports come out after close. We have earnings that come out after close. On the overseas markets, they're trading while we sleep. And there's a lot of other fundamental and technical factors that do affect our economy. And when it affects our economy, it kind of affects the market sentiment. There are political things that go on that can happen overnight that can change the feel of the market, or in particular the stock that you're looking to trade. So it's very, very important that you understand this and know that the morning is really going to be key in determining which direction we may be heading that day. Now, I used to look for stocks to day trade the night before. Some people preach being prepared the night before for the next day, having your watch list and everything. But I found that the strategies that I trade, that was not feasible, because like 70% of the stocks that I look at the night before were not in play the next day. They never got the volume, never got the activity it needed, the volatility it needed in order to make any moves. So it's like I was wasting a lot of my time at night looking at these stocks. So I wait for the next day, look for the stocks that are moving, that have volume, and you guys see that when I do the morning show, or you're in chat, so you see me do it every day. I'm looking for the stocks that are moving, and these are the stocks that are probably affected by all of these events, one or more of these events that happen overnight or between the time we close and then the time the market opens the next morning. All right, so typically during the first half hour of the trading day, and that usually is the most emotional part of the trading session, because you're going to have people freaking out if their stock gapped up and they're short, or if their stock gapped down and they're long. They're going to be freaking out trying to dump if the stock they're in put out some bad information and all of that. And as Nate would say, you got people grabbing their old shit handle, hanging on, trying to figure out what to do. And that's usually what happens at the open. Institutional traders will then come in the market, start buying and selling big quantities based on, what their models are telling them. Or if they're caught in one of these situations, they're going to try to either hold the stock up or do whatever they can until they get out. That's been proven through interviews. I think I shared one in chat from, I always forget this guy's name because he drives me insane. Jim Cramer. I can't really listen to him on TV because he drives me insane. But he was a fund manager, and he pretty much gave all of the secrets of how they manipulate, and when they have to get out, how they can work the system so that they don't get hurt as bad. The volume is so big at the open. That's where all the volatility is. That's why a lot of people say they trade the open. They trade the first hour of the day and they shut it down, because that's where most of your movement's going to come. And it's very difficult to really see what impact the overnight market is going to have, until the stock market actually opens. Now we can get a glimpse pre-market. I also look at the E-mini futures, the S&P E-mini futures, to kind of get an idea. But really, when the stock market opens, that's really gives you the true picture. Because many times I've looked at the futures and I've looked at the SPY early and see that it's trading maybe below the VWAP, and I'm thinking that the market is going to sell off a little bit, and in the first 15 minutes of open, it's claimed the VWAP and is running up. So I like to wait for the open and make sure that we're getting what we need. Other thing, if we are, the reason why we don't just trade range breakouts, the reason why I focus on opening range breakouts is you run into too many false breakouts if you move later on in the day. Later on in the day, the volatility is down, the volume is down, so you may run into some false breakouts. It may break out and then turn around and pull back, and we see that in our trend continuation trades. That's just what I look for. I look for a false break, and then I can take my trend continuation back in the direction that it's going. Most of them are going to be short. That's kind of what I like doing now. But every now and then I'll get some, to the long side. But you don't want to go past the first 30 minutes or so if you're trading an open and range breakout. Now you can stretch it out to an hour, and I'll show you an example today of a stock last week. And we do see these that will trade sideways for an hour, and then it'll make the move. It'll break to the downside or the upside. And it'll trade in the range and then make that move. So by the very nature of a range, it is likely to have multiple false breakouts. And that's because it's kind of a supply zone. You've got buyers and sellers in that range, both trying to push it in either direction. And a lot of times these false breakouts occur because our support and resistance is not going to be 100% accurate. And we have these institutional traders, and they're even private traders who use algorithms, and they're based on different supply zones. They're based on different areas of support and resistance. They're based on different indicators. And so they can break out, or they can act a certain way in the middle of nowhere, and you not really understand what it's doing, but it's all because somebody else is using some obscure area for support and resistance, and the stock is reacting there. So I don't typically trade, and I don't advocate trading just range breakouts. Has to be an opening range breakout. And that's kind of what I wanted to, I wanted to throw that out there, because I don't want you to get the wrong idea or the wrong impression that you can trade this all day. I mean, you can. Obviously you can, because you've got flat top breakouts, you've got the flag breakouts that we trade, breakouts over high day, and you can use other filters to try to help you determine whether this is going to be a solid breakout or not. But for me, I like to stick to the opening range, because it's a little bit more predictable once it sets a direction in that first 30 to 45 minutes of the market. Alright, so again, every stock creates an opening range with a specified time frame at the open. It could be 1 minute, it can be 2 minutes, 5 minutes, 10 minutes. Like the gap and go is based off of a 1 minute opening range breakout. It's basically an opening range breakout on steroids. The problem is it's a guessing game, because it can get bought up real quick and then slam back down, and you'll be down big money before you even know it. So you can do the 2 minute opening range. Now, I've done the 2 minute a couple times. I almost did it Thursday, and I should have done it Thursday, but I was just frozen and didn't take it. Didn't take the trade. Would have been a very lucrative trade, but I will use the 2 minute sometimes. 5 minute is the most dominant one that I use. And like I said, when I was at work, the 15 minute was what I used. Even sometimes a 30 minute. But the market has to be trending pretty good in order for these later time frame opening range breakouts to work. There is some guy that has a 60-minute strategy that he waits the first hour, and then he'll enter a position once you get above or below that 60-minute opening range. But if you're in a market that's kind of trading sideways, or that's just overextended, it's going to be very tough to trade these. Fortunately for me, when I first started trading these opening range trades, the market was strong, it was solid, and I was only trading to the long side, and I was finding opportunities left and right. But now, the market is kind of funny. It's not as volatile as it was then, so the moves are going to be somewhat limited, and you're going to have to take them a little bit earlier in order to get this profit. So the high and the low of the range, whatever you determine, will act as support or resistance. Now, when we look at these charts here in a few, you'll see what I'm talking about if you can't picture it. But that's my last, even though we're basing the trade off of the high and the low of the opening range, that's my last case scenario for using support and resistance. I like using the technical levels that are already on the chart, whether it be VWAP or moving averages or daily support and resistance. I like to use those versus the opening range of the candle. But when we first start learning this and we're trading without any indicators because we want to learn the price action of the trade, then we will use the high and the low of the range to act as support or resistance. And the simple methodology of this is that you buy long when the stock moves above the opening range high, which is the opening range breakout, or you sell short when the stock moves below the opening range low, which is the opening range breakdown. That's as simple as you can get. And for a long time, these trades were working like clockwork. But now we have more of the automated trading systems out there that create a little bit more havoc in the market, a little bit more uncertainty. So these moves aren't as clean. And when the market is trading the way it is now, you're going to have to use a little bit more discretion and one or two more filters to help you determine whether the stock is actually going to break out or break down and give you a sustained move to the downside. All right, so you can see we let the first 5-minute candle print. We got the high and the low of the range set. We've got this candle that opened, and it opened red, which we're going to see. We had a slight dip right back to this 1785 level, the low, right on 1785. And then we start getting bought up. And we start getting bought up. This is a strong move up. So we can do two different things. We can buy this on the break of the opening range high. Let's say we set our order at 1850. Say we have a limit order set for 1850. Already out there ready to buy this. And it hits 1850. Our first cover is, for me, the way I'm doing this, it's going to be 50 cents. Whole dollar mark. If I'm in at 1850, I'm looking at the next whole dollar mark potentially for my cover. Now sometimes I'll be greedy and put it 5 cents above it. But we would have been hit right here. Half our position is out. Then automatically I'm going to have my stop at break even. So we've already made money on this trade. This is a simple opening range breakout. But what we did was we had to wait for this to set. Wait for the opening range breakout to set. Wait for the next candle to tell us what it's going to do. Just because this candle is red doesn't mean it's going short. And people who were anticipating this, and believe me, there are a lot of people who saw this, saw that this candle opened red and it was starting to dip, went short. And then all of a sudden they got stopped out. And this is probably what aided this candling and this strong move up, where you had a lot of people covering because they were looking for this to kind of recover this big gap. They're anticipating. And I guard against that. That's why I like to wait for this opening range to set and let the market tell me what it's going to do. I'm not going to guess it. I'm not going to guess at what it should do. I'm going to let it tell me. Now, sometimes it will fool me, but that's where your stops come in play. So where are we going to place our stop on this? if we're not using any indicators, if you're practicing this and you're trying to learn the strategy and all the variables to it, what you're going to do is use the opening range high as your support. Once we break through this, this is your support. If we go up and come back down and close below this level, then you need to take your trade off. No questions asked. Don't sit here and say, well, maybe it's going to bounce and go back up. If it does that, then just get back in. But you have to protect, your account at this point. If it comes back below here and closes, who's to say it's not going to continue to go back down? And the more it goes down, the deeper in the hole you're going to get. I'd rather lose a couple dollars here and gain it back on the right move up versus losing it here. So in this case, we would get in. Our stop would be a close back below this level. We take profit, and immediately once I take profit, my stop loss goes right to break even. So if I entered it at 1850, that's where my stop's going to be. And as you can see, this candle opened, and this one had a big washout, but it never made it back to my entry price. That's why I will not tighten my stop all the way up. I will give it will have to come back and hit me at break even. And this is exactly why I do that. Because had I put my stop up here, I would have been stopped out and missed this move here. And then I would have missed this next move. It didn't really get any further than this, but still, I would have missed some of this move. So it's important that we do this and that we put our stops and we use these technical levels as our stop. Now, you're going to see later on when I add the moving averages in and when I add the daily levels in, how that's going to change the way I manage my trade. But when you're first learning this strategy, when you're first learning any strategy that's dealing with candlestick formation, you want to use as clean a chart as possible so that you can learn the price action and learn how this strategy works and learn how this strategy fails. What happens when a stock fails. How to be able to determine the price action on a stock that fails without having to use any indicators, without having to use anything else on your chart, just reading the price action. And I know I say this every week, but reading the price action is the most important skill that you're going to have to develop, especially if you're going to survive a down or a slow market. You have to be able to read that price action and know when to take profit and when to get out of something before you lose your shirt. All right, so we looked at AKRX, and that was an example of a delayed breakdown. And it didn't break out until after 10:30. So that was a pretty good example of the stock traded in its range, but then we didn't get the breakdown. And I usually take those stocks off my watch list or off my platform at 11 o'clock. Because that's when I actively start looking for reversals and more trend continuation trades. But you saw that stock just barely made the 11 o'clock cutoff. And also I need to see the bias towards one particular direction. So I like to see more candles going in the direction that I want to go in. When I see the market swinging back and forth between the high and the low of the opening range, that's when I usually say this market is choppy and there's really no trade in it because it's trading in a range. And when I see this, I typically avoid getting in the trade. Even if all the other conditions have been satisfied, I will not get in the trade. Now, the ideal market action prior to breaking out of the opening range, it usually occurs when the market tests either the high or the low of the range on more than one occasion. Usually, the next candle would either come back and test that level it just broke out. And in that case, if it tests and holds, then we've got a strong move to the upside. So let's take a look at this again. Here in this case, we just tested the low here, and the low held. So those that jumped in before this thing really faded got stopped out. So here is a move up. This candle came back and almost tested this level. We got within what, 10 cents, which is within that supply zone around this 18, around the 5-minute open range high. So it did come back and test it a little bit, and it gave us a stronger move up. It propelled it up a little bit more. It gave us what, about 50 more cents. So that was a solid move up. And that's what I mean by, you'll see more and more stocks. And as you see, not every trade and not every setup is going to be exact. So when we start looking at some live examples here, when we start seeing some live examples here, then you'll see what I'm talking about. You're trading the same setup, but no stocks are going to set up the same. What I don't want to see is a stock swinging back and forth in a choppy trading range between the high and low of the opening range. And we see that a lot. We're going to see that here when we look at some more charts. We're going to see these stocks that chop between the range and never really move, never really break out. And if they break out, it's only a couple of cents and then it comes back. And that's why after a certain period of the day, there's no need watching these stocks because they're not going to give you what you want. I give them an hour or so, I'm done with them. They're not going to give you, what I want. So it's key that you know when to cut them loose and start and move on to your next strategy.